Hello everybody, and today we will talk about subprime mortgage crisis. This crisis didn't just hurt homeowners, it had a ripple effect on the global economy, leading to the Great Recession, which lasted between 2007 and 2009. This was the worst period of economic downturn since the Great Depression. After the housing bubble burst, many homeowners found themselves stuck with the mortgage payments they just couldn't afford. Their only resource was to default. This led to the breakdown of the mortgage-backed security market, which was blocks of securities backed to these mortgages, sold to investors who are hungry for great returns. Investors lost money, as did banks, with many teetering on the brink of bankruptcy. Subprime mortgages are named for borrowers that the mortgages are given to. If the prime rate for a mortgage is offered to people with a good credit and history of dependability, subprime is for those who have struggled to meet those standards. People who are approved of subprime mortgages historically have low credit scores and problems with debt. There is no exact established number, but a FISO score below 640 is generally seen as a prime for a loan like a mortgage. People with sporty credit histories like these often have tremendous difficulty getting approval on mortgage, and as such, the monthly payments have much higher interest rate than normal, since the lenders view the loan as riskier. Now we can take a look at key payers and components that lead to subprime mortgage crisis. Anytime something bad happens, it doesn't take long before people start to assign blame. It could be as simple as a bad trade or an investment that no one thought would bomb. But some events have such a devastating effect that they end up having an effect on the overall economy. When it comes to subprime mortgage crisis, there was no single entity or individual at whom we could point the finger. Instead, this mess was collective creation of the world's central banks, homeowners, lenders, credit rating agencies, underwriters, and investors. How did the USA economy get to a point there in 2007? A full housing crisis began? It doesn't happen overnight. In the early to mid 2000s, interest rates on house payments were actually quite low. In that looked to be a solid economy after a brief early 2000s recession. More and more people with a struggling credit were able to qualify for subprime mortgages with manageable rates and happily acted on that. This sudden increase in subprime mortgages was due to a part of the Federal Reserve decision to significantly lower the federal funds rate to spur growth. People who couldn't afford homes or get approved for loans were suddenly qualifying for subprime loans, and choosing to buy an American home ownership rose exponentially. Housing prices were rising rapidly, and the number of subprime mortgages given out was rising even more. By 2005, some began to fear that is a housing bubble. From 2004 till 2006, the Federal Reserve raised the interest rate over a dozen times in attempt to slow this down and avoid serious inflation. By the end of 2004, the interest rate was 2.25%. By mid-2006, it was 5.25%. The subprime mortgage crisis, which guided us into the Great Recession, has many parties that can share blame for it. For one, lenders were selling these as mortgage-backed securities. After the lenders approved and gave out a loan, that loan would be sold to an investment bank. The investment bank would then bubble with this mortgage with other similar mortgage for other parties to invest in. And the lender would, as a result of the sale, have more money to use for home loans. Lenders were far too ready to give away so many risky loans at once, seemingly assuming that housing prices would continue to rise and interest rates would stay low. Investment banks seems to have had similar motives, getting bolder with their mortgage-backed securities investment. The increased use of the secondary mortgage market by lenders added to the number of subprime loans lenders could originate. Instead of holding the originate mortgages of their books, lenders were able to simply sell off the mortgages on the secondary market and collect the originating fees. This freed up more capital for even more lending, which increased liquidity even more, and the snowball began to build. A lot of demand for these mortgages came from the creation of the assets pooling mortgages together into security, such as collateralized debt obligations. In this process, investment banks would buy the mortgages from lenders and securitize them into bonds, which were sold to investors throughout CDOs. A lot of criticism has been directed at the rating agencies and underwriters of the CDOs and other mortgage-backed securities that included subprime loans in their mortgage pools. Some argue that rating agencies should have foreseen the high default rates for subprime borrowers, and they should have given these CDOs much lower ratings than AAA rating given to the higher quality tranches. Fuel on fire investor behavior, just as the homeowners are to blame for their purchases gone wrong, much of the blame must also be placed on those who invested in CDOs. Investors were the ones willing to purchase these CDOs at ridiculously low premiums instead of treasury bonds. In the end, it's up to their individual investors to perform due diligence on their investment and make appropriate expectation. Investors failed in this by taking AAA CDO rating at face value. And don't forget the hedge funds. Another party added to the mess was the hedge fund industry. It averaged the problems not only by pushing rates lower but also by fueling market volatility that caused investor losses. The failures of few investment managers also contributed to the problem. The biggest culprit, the lenders. Most of blame is on the mortgage organizers or the lenders. That is because they're responsible for creating these problems. After all, the lenders were the ones who advanced loans to people with the poor credit and the high risk of default. When the central banks flooded the markets with the capital liquidity, it has not only lowered the interest rates, it also broadly depressed risk premiums as investors looked for riskier opportunities to bolster their investment returns. At the same time, lenders found themselves with the ample capital to lend, and like investors, an increased willingness to undertake additional risk to increase their own investment returns. The subprime mortgages disappeared for a while after they signed. They were seen as one of the largest part of the economic collapse. There may have been a mix of factors and participants that predicted the subprime mess, but it was ultimately human behavior and greed that drove to demand, supply, and investor appetite for these types of loans. However, there are countless examples of markets lacking wisdom. It seems to be a fact of life that investors will always extrapolate current conditions to far into the future. We also recommend you to take a look at the movie The Big Short that shows how it was from the inside. And for today, that is all. Thank you so much for your attention. Please stay safe and well. See you soon.